Hello everyone. In my last video, I talked about intercompany adjustments on consolidation of financial statement, as well as unrealized profit arising from the purchase and sales of goods between holding company and a subsidiary. During that video, I made mention of the fact that I'll be talking about impairment of assets, as well as impairment of goodwill. Let me just draw our attention to IAS 36, impairment of assets, what the standards talk about, and how to start looking for how to test impairment of the assets. So according to IAS 36, impairment will occur when the recoverable amount of an asset is less than the carrying amount. So what this means is that the carrying amount is the book value of the assets in the books. I mean of the identifiable net assets in the books, while the recoverable amount is what we can get in value for the assets, either by looking at the market or looking at maybe the cash flow that will flow to the entity over a period of time. So let me just use a simple example to explain what recoverable amount is. Recoverable amount, according to IS 36, is higher of fair value less cost to sell and value in use. So what does fair value mean? Less cost to sell. Fair value is the recognizable maybe market value that we can get from the sale of the assets. And when we're trying to sell the asset, there maybe there's some significant cost attributable to the sale. So that cost will be deducted from the fair value of the asset. Why value in use is determined by looking at the discounted cash flow that will flow to the entity over a period of time. So when you now compare this value with what we call carrying amount in the books, then will determine whether an asset has been impaired or not. So according to IAS 36, impairment of assets, uh, there's a lot of indications to determine whether you will need to test for impairment, because the standard does not say that we should test for impairment of other assets. I mean the normal property, plant and equipment every year. Unlike the goodwill that the standard talks about, that we test for impairment on annual basis. For other assets, is only when there's indication of impairment. And what are these indications? Can be number one can be maybe evidence of or obsolescence of the asset. Maybe there's a particular damage that we have seen in the asset, so it is expected that we test for impairment so that we can take it back to the value, that I mean the recoverable value of the asset, instead of just carrying a bogus asset in our books. Or number two can be maybe significant decreases in the market price of such asset. Maybe at a point in time an asset is being sold for $10,000, and maybe over a period of time we discover that, oh, it's only $4,000 that asset worth. So we need to test for impairment of our existing asset. Or it can also be as a result of significant technological, economical, or political changes which has occurred in a period of time, and this we think will impact the use of such assets. It can also be maybe as a result of maybe economic performance on the asset. Maybe the asset is not generating enough cash flows that is expected of it. So maybe the value is overrated in the books, and we need to test for impairment. But for the purpose of this discussion, we'll be talking about basically goodwill impairment. So maybe I'll do another video separately to talk fully and do some examples on the impairment of other assets. But for the purpose of this discussion, I'll be focusing on goodwill impairment. So goodwill is expected to be tested annually for impairment according to ISS, as I stated earlier on. Unlike in some standards like the UK gap, which state that goodwill is to be amortized over its useful life. It can be maybe 5 years, 7 years. Um, but the standard, I think the gap focuses on maximum of 10 years when you're testing, when you amortizing goodwill. But for the purpose of IS 36, we need to remeasure the goodwill annually, not to be to amortize it. So it's from the remeasurement of the goodwill we know whether there's need to impair it uh, in the books. So when you are impairing goodwill, it is expected to also note that goodwill, that's why I make a note here, goodwill is not a cash generating unit. It is not a separate asset on its own that can generate cash for the entity. So in this case, when you are testing for impairment of goodwill, you test it alongside other assets. So you cannot test goodwill separately for impairment. So when you now test it along other assets, then you can now determine whether there is impairment or not. Another rule of testing for impairment in goodwill is that when you discover that there is impairment in goodwill, the standard states that um, that impairment value should first of all be allocated to the goodwill itself in the books up to the value of the goodwill, then to other class of asset on pro rata basis. So that is what the standard says. So if you have, say you have a goodwill of $10,000 in the books and you tested for impairment and the payment value shows $5,000, it means $5,000 will be allocated to goodwill in full because the value of the goodwill in books is still more than the $5,000. But when assuming $10,000 is the value of the goodwill and you have allocated some portion, let's say the payment value now shows $20,000, then it means you write off the goodwill in full. The balance $10,000 will now be allocated to the other class of the asset on pro rata basis. So I will be drawing on the example. I just made a simple example here so that we can understand how to test for impairment. Another thing to note is that when we're testing for impairment, you need to first of all understand how we arrive at the goodwill. If we have adopted a full goodwill approach, or if you have adopted a partial goodwill. For a full goodwill approach, it means that when we're calculating uh, uh, the NCI will have been recognized at its fair value. That is why we call it a full goodwill approach. So that full goodwill approach, when we determine the impairment on the value of the asset, we now share uh, that impairment, what is to be to be posted to the profit and loss account, we share between the holding company and that's and the value of the NCI. But I'll during this discussion I'll make a example of how that will be treated. So let's run through the example first. So looking at the example, we see that Company A acquires 70% of the shares of Company B. At the end of the year, the carrying amount, that's what I said, the carrying amount of Company B's net identifiable assets is $50,000. So this net identifiable asset that we are talking about, in some other examples, they may split it between maybe share capital, share premium, retained earnings, and others. But for the purpose of this discussion, we only focus on having a single figure of net identifiable net asset, while its recoverable amount according to the market is $55,000. So what we're saying is that we have done estimation, we have done a fair valuation of the the net asset of the subsidiary, and the market value is showing $55,000. This amount that we have here is a recoverable amount that we think we can get from that asset, from that subsidiary. So the goodwill on acquisition was $12,000. Calculate the impairment in goodwill. Impairment in goodwill. I think I so calculate the impairment in goodwill using a full goodwill method. B, using a partial and goodwill method. So both methods is what we demonstrate uh, with this example. So let me put a solution to make it easy for us. So I'll break it down to solution A, solution B, solution A, that is full goodwill method. So under this solution, um, the full goodwill has been used, so there's no need to start looking of recalculating the goodwill that we use in testing the impairment. So the first thing you need to look at is what is the carrying amounts of net assets of company B. So let me put this here. Um, the next one is 50,000. Yeah, that's it. Make it neat. Then, then okay. Then we now bring goodwill. Don't forget we said full goodwill was used. So full goodwill. So we assume that the value of the goodwill that was given in the question, which is $12,000, is a full goodwill. So, so then we now sum it. 62,000. Then we now take out the carrying. No, the recoverable value of net assets. So the recoverable value of net assets be deducted, and that should be 55,000. So if this is A, this is let me call X, Y. So if X is greater than Y, then payments. So what do we have? Do we have impairment? Yes, we have impairment. Because the carrying amount is more than the recoverable amount. So that $7,000 is what we call impairment of goodwill. So what we now do is, because we are using a full goodwill approach, that $7,000 will be shared. Appropriation, let me say appropriation of impairment. So that appropriation of impairment will be let's see, company A share of impairment be what? 70%, right? That's the holding. 70%. While NCI share of impairment be the 30%, which is the difference. So um so in the books, what we need to do is just, I mean, the journal entry. Journal entry is to debit profit and loss. Bit, bit, bit. Debit profit and loss with this. And debit NCI with this. then credit will. This. So so you can see that because the full goodwill approach, we have splitted it between NCI and the shareholding. So that's how that's be treated under the full goodwill approach. So, but in a partial goodwill approach, so solution B, solution B will be partial goodwill. B, partial goodwill approach. So partial goodwill method. So what we do here is um in calculating our goodwill, I will use the same template I have here. Yeah, the same template. Let me copy the same template. Uh, uh, Copy the same template. So come in. So stand there. So here the only difference is this row here. So the carrying amount of the net asset is the same. So what we only need to do is to gross up, because it's a partial goodwill. Gross up goodwill, and this will be the goodwill value that we have here is $12,000. We now divide it by 70%, which is the holding of the holding company. So when you have to divide it by 70%, then it means the value will go up. Yeah, this is the gross value of the goodwill. Can you see the gross value of the goodwill? So it's showing 17,140. So when we now compare with the recoverable amount, it shows an impairment of 12,143. So remember what I said earlier on, that when we have um, goodwill, let me say goodwill is 12,000. That was the goodwill that we had in the books. So what we now do is this: the journal entry will now be different. But the journal entry here will be um debit profits and loss like we used to do. But what value are we debiting to profit and loss is only 70% of this impaired value. I mean this impairment. The reason why we're taking 70% because the original goodwill that was in the books is 70%. It's only when we are trying to calculate it that we cross it up. So this 12,000 is 70%. So this is partial goodwill. Then we now credit goodwill, same value. So the difference between this partial goodwill method and full goodwill method is the realization of a debit entry to NCI, while the full value will be credited to goodwill. So that's the difference. Thank you.